In this lesson, we're going to talk about Chapter 12. We're going to apply the capital asset pricing model to determine what an appropriate discount rate is in some situations, and talk about some potential problems that can occur. The key concepts then, how to determine a firm's cost of equity capital, and the impact of beta in determining the cost of capital, and determining the overall cost of capital of a firm, as in the weighted average cost of capital. Chapter is outlined as shown here. So where do we stand? In earlier chapters we focused on cash flows, on the determining the size and the timing of those cash flows, and we've just sort of assumed that the discount rate was going to be handed to us. In this chapter we're going to focus more on the discount rate and decide how we determine what an appropriate discount rate is. So let's say that a firm has some excess cash. Assuming they have investment opportunities, then they have two choices. And by the way, a firm always has an investment opportunity, but it may not be a positive net present value investment. So a firm with excess cash can either invest in a project, and if they do, the shareholders will ultimately receive the terminal value of that project, or the firm can pay a cash dividend. And if the firm pays a cash dividend, then the shareholders themselves can invest in some kind of financial asset, do the same thing basically the firm would have done, and then the shareholders again receive the terminal value. The point is that because shareholders can reinvest the dividend in risky assets, the expected return on a capital budgeting project should be at least as large as the return on the financial assets of comparable risk that the investor can invest in. Let's return to the capital asset pricing model. From a firm's perspective, the return on the equity is given by the capital asset pricing model, which says the expected return on a security is equal to the risk-free rate plus beta times the market risk premium. And remember that the market risk premium is RM minus RF, and the beta is given by the covariance between the returns on the security in the market divided by the variance of the returns on the market. So let's think about Stanfield Enterprises. They publish PowerPoint presentations and they have a beta of 2.5, and the firm is 100% equity financed. We'll assume that the risk-free rate is 5%, the market risk premium is 10%, and we'll ask what's an appropriate discount rate for an expansion of this firm. We can plug these numbers into the capital asset pricing model, and if we do, we find that the expected rate of return for the firm is 30%. So we could safely say that if a firm is investing in the same kind of investment, in other words PowerPoint presentations of some sort, and if the firm is going to use the same amount of debt in the capital structure for this project as they have now, then an appropriate discount rate might be 30%. All right, so let's look at Stanfield Enterprises, which is evaluating 3 independent projects, and each project costs $100 and lasts 1 year. The first project, Project A, has a beta of 2.5. In fact, all the projects have a beta of 2.5. The expected cash flow for Project A is $150, giving us a 50% return. And remember that the firm requires a 30% rate of return for projects of this risk. And so the net present value using 30% for Project A would be $15.38. Project B gives us a 30% return or has a net present value of 0. And Project C actually has an internal rate of return of 10%, which is less than the required cost of capital and would actually have a negative net present value. If we plot these 3 points on a plane that has the internal rate of return on the y-axis and beta on the x-axis, we see that the 3 projects line up. All 3 have a beta of 2.5. Project A has the 50%, B has 30, and C has a 10% return. And basically, for an all-equity firm, we can put the security market line on here. For this beta, we would accept all of the projects that are on the security market line or above it, and reject C as a bad project. Now, if we're going to estimate beta, one of the things we're going to need is a market portfolio, and I've discussed this earlier, but in theory, the market portfolio would be the portfolio of every asset in the economy, and we have no way to measure the returns on the market portfolio. So in practice, what we do is we use a proxy, and the proxy is usually a broad stock market index. Standard & Poor's 500 is probably the most widely used. We could use the Dow Jones Industrial Average, but that only contains 30 stocks. We could also use some other indices like the NASDAQ, but the NASDAQ is pretty heavily loaded with small cap stocks and technology stocks. Now, beta is the sensitivity of the stock's return to the return on our market portfolio, or the proxy to our market portfolio. And we're going to hope that the proxy doesn't do too much damage. So to calculate beta, remember beta is the slope of a regression line that plots the returns on the security with the returns on the market. We will take the covariance between the returns on the security and the returns on the market and divide by the variance of the returns on the market. Some potential problems with beta. First of all, it may vary over time, and this has been studied. The sample size may be inadequate. We have a couple of problems. If we have a very large sample size, then beta is going to be perhaps not representative of where we are today, and if we have too small a sample size, we may have statistical weakness in our estimate. And third, betas are influenced by changing financial leverage and business risk, and we're going to talk about number 3 in more detail. The solutions to these problems, problem 1 and 2, we have some statistical techniques that we can use to correct for variance over time and sample size. Problem 3 can be lessened by actually taking into account changes in business, the business cycle, and the level of financial risk. We can also look at an average beta estimate for an industry rather than using the beta for a particular firm, especially if we believe that the firm and the industry track closely together. In other words, the industry is quite representative of the firm. Then we could use the beta for the industry. Now, how stable is beta? This has been studied, as you might guess. Most analysts argue that betas are generally stable. I've actually looked at this myself. Some betas can vary greatly. Some betas are quite volatile. Other betas are fairly stable. So beta certainly can change. It can change because of changes in production technology, in deregulation, in changes in financial leverage, and for just a host of other things. In fact, most things that could affect a security's return or the market return can also affect beta. Now, what about using an industry average beta? Well, many have argued that that can be a better estimate of a firm's beta. And if you believe, and I said this earlier, if you believe that the firm can be represented well by the industry, then it would probably make sense to use an industry average beta. On the other hand, if you believe that the firm is quite different from its industry, then it would probably be more appropriate to use the beta of the firm itself. Now, then don't forget, we're going to have to make adjustments in the firm's beta for financial leverage. In other words, what they're saying there is if you decide to use the industry average beta, then you may have to make changes in an individual firm because that firm is more highly levered or less highly levered. Okay, what are the major determinants of beta? First is business risk, and the second is financial risk. Now, business risk is not just, it's not just the volatility of returns. Business risk is caused by two things, cyclicality of revenues and operating leverage. Now, when we talk about operating leverage, we notice that operating leverage is a percent change in EBIT for a percent change in sales. And for example, if a 10% change in sales causes a 20% change in earnings before interest and taxes, then we would say we have operating leverage. So the more operating leverage is caused by fixed costs. So the more fixed costs we have, the more operating leverage we have, and the more widely cyclicality will affect our revenue stream. Financial risk, of course, is just caused by the fact that interest payments are a fixed cost of doing business. So cyclicality of revenues, highly cyclical stocks will have higher betas. They will tend to have more variability with respect to the market. Examples of highly cyclical stocks would be retailers. We all know that when the economy turns down, people quit shopping and quit buying automobiles and things like that. On the other hand, transportation firms and utilities and perhaps healthcare, things like that, are less cyclical. You know, people have to have food, for example, whether the economy is up or down. They may cut back a little, but they still have to eat. Note that cyclicality is not the same as variability. So stocks with a high standard deviation don't necessarily have to be high beta stocks. Remember, standard deviation is total volatility. It's total risk, and total risk consists of two components, systematic and unsystematic. And we can diversify away unsystematic risk. But the systematic risk, the part of risk that varies with the market, we can't diversify away, and that cyclical component tends to be systematic. We can't diversify it away. Movie studios tend to be quite variable. A company has a big hit, Harry Potter movies, and all of a sudden revenue is up. Company has a flop and revenues are down. Now, operating leverage then is, again, the degree of operating leverage tells us how sensitive a firm or a project is to its fixed costs. And the more fixed costs we have, the higher the operating leverage will be. Operating leverage essentially magnifies the effect of cyclicality on beta. And so the degree of operating leverage is the percent change in EBIT divided by a percent change in sales. And as I said, if we had a 20% change in EBIT for a 10% change in sales, we would say we have a degree of operating leverage of 2. Here's a little picture. First of all, I don't know if you can see the colors, but the red here represents a company with low fixed costs and high variable costs. And that red company has a low degree of operating leverage. So if you look at the firm on the right, a small change in sales will cause a small change in EBIT. On the other hand, the black represents a firm with high fixed costs and low variable costs. And for that firm, the line is much steeper, so a small change in sales will cause a much higher change in EBIT. Bottom line, operating leverage increases as fixed costs rise and variable costs fall. Now, what about financial leverage and beta? First of all, operating leverage is the sensitivity of the firm's fixed costs of production, and financial leverage is sensitivity to fixed costs of financing. The relationship between the beta of a firm's debt, equity, and assets is given by this. In other words, the beta of the assets is a weighted average of the beta of debt and the beta of equity. Now, generally speaking, it's a reasonable estimation, it's a reasonable approximation to assume that the beta of the debt is about 0. And the beta of the assets is pretty much independent of whether we have debt or equity. In other words, how we finance the assets doesn't change how volatile they are. So the beta of the assets is fixed. Beta of debt is essentially 0, which leaves us that the beta of assets is equal to the percent of debt times the percent of equity times the beta of equity. And what that means, bottom line is, if we do a little algebraic manipulation, if we increase debt, we will decrease the percent of equity and we will increase the beta of equity. So financial leverage, in other words, using debt in the capital structure, increases the equity beta relative to the asset beta. Here's a little example. Let's say we have a company that has an asset beta of 0.9. Now, the asset beta will remain 0.9 regardless of what happens. And right now the firm is all equity, so there is no debt. But let's say the firm has decided to issue some debt and use the debt to buy back equity, so it's going to change its capital structure, and it's now going to be 1 part debt and 1 part equity. All right, so if we play around with this a little bit, what we see is that the beta of assets, which is 0.9, is going to be the percent of equity times the beta of equity. And the percent of equity is now 50%. And mathematically what that means is that the beta of equity has doubled from 0.9 to 1.8. Okay, some extensions of this model. We'll look at the firm versus the project and the cost of capital with debt. So firm versus the project. When is it appropriate, I guess, is the question. When is it appropriate to use the firm's cost of capital, and when should we turn our back on the firm's cost of capital and just look at the project and calculate a separate cost of capital for the project? And the answer is this. Anytime you have a project that has the same basic risk as the firm and is going to use the same amount of capital, then it's appropriate to use the firm's beta. So it depends on the risk of the project and the risk of the company. Here's an example. Here's a firm. There's the beta of the firm, and we plug the beta into the capital asset pricing model, and we get what's called the hurdle rate, which would be the firm's required rate of return. Now, on this graph, we have put some projects, and over here to the left of the beta, we have got low-risk projects, and they have a low return. And over to the right, we have some high-risk projects, or higher-risk projects, and they have a high return. Now, if we were just using this one-size-fits-all, we're going to use the firm's cost of capital as a hurdle rate. We would reject all of these projects down here because they are below the hurdle rate, and we would accept all of these projects up here because they are above the hurdle rate. What we would be doing is, over time, increasing the risk of the firm and decreasing its value. In other words, we're kind of going the wrong way. What we want to do is reduce risk and increase value. So let's put the security market line in, which tells us the required relation between the beta and the expected return. And now you see that these projects which we were planning to reject actually have a rate of return higher than the required rate of return, and for the level of risk involved, they should be accepted. And these projects up here, which we were going to accept, actually should be rejected because they don't give us a high enough return relative to their level of risk. So we would have incorrectly rejected positive net present value projects, and we would have incorrectly accepted negative net present value projects. We would have loaded up on high beta, negative net present value projects, and thrown out positive net present value, low beta projects. We would have increased risk, and we would have reduced net present value. Okay, so let's think about a company. Here's Conglomerate Company. It has a cost of capital based on the capital asset pricing model of 17%. The risk-free rate is 4%, the market premium is 10, and the firm's beta is 1.3. So you can plug these in. 1.3 times 10 is 13, and 4 is 17. That's where the 17% firm cost of capital came in. But let's take a closer look at Conglomerate Company. It's a 1/3 automotive retailer, 1/3 computer hard drive manufacturer, 1/3 electric utility. I'd love to know who put this thing together. The beta of auto retailers is 2, so apparently that's a fairly high-risk business. The hard drive manufacturer has a beta of 1.3, and the electric utility has a beta of 0.6. Now the weighted average beta, sure enough, 1/3 of 2 plus 1/3 of 1.3 plus 1/3 of 0.6 is 1.3. So that's where the beta of the average beta of the firm came from. It's the weighted average of each of the business segments. Now, if we're evaluating a new electrical generation investment, should we use 1.3? And the answer is, of course, no. An appropriate beta for that would be 0.6. And if we do use 1.3, we're going to unfairly penalize those projects which have low risk and force them to have a much higher rate of return than they have to have. So there you have it. The beta is 0.6, required rate of return is 10. A beta of 1.3 gives us a required return of 17, and a beta of 2 gives us a required return of 24. So if we're evaluating these automotive retailers, we should use a 24% return. If we're evaluating the computer hard drive manufacturers, an appropriate rate would be 17. And if we're evaluating these electric utilities, an appropriate discount rate would be 10%. All right. 10% would reflect an opportunity cost of capital. If we do anything else, we're going to be making some mistakes. We will end up loading up on the high-risk projects and throwing it. We'll starve the 1/3 of the business to death and unjustly enrich 1/3 of the business and end up causing the shareholders wealth. Okay, now investment in hard drives or auto retailing should have higher discount rates than that 10%. All right, what about with debt now? Here's a weighted average cost of capital. The weighted average cost of capital is the percent of equity times the return on equity plus the percent of debt times the return on debt, and it's actually the after-tax return on debt because remember, debt is tax deductible. Debt is a cost of doing business. Equity is not tax deductible. So we can write this a little differently. S stands for equity or stock, and B stands for debt or bonds. And because interest expense is tax deductible, the last term is multiplied by 1 minus TC, where TC is the marginal tax rate. All right, let's go back to international paper. First, we're going to estimate the cost of equity and the cost of debt to get the weighted average cost. So we estimate an equity beta by using the capital asset pricing model. And we can often estimate the cost of debt by using the yield to maturity. Remember back when we talked about bonds, we derived yield to maturity. And we determine the weighted average cost of capital by throwing those two components into the equation with the appropriate weights. So here's beta. Here's international paper. The industry average beta is 0.82. The risk-free rate is 3%, and the market risk premium is 8.4. And so the cost of equity capital for the paper industry, putting those things in our equation, is 9.89. Now, as long as International Paper is a reasonably typical paper company, it's fine to use this industry average cost of capital for equity. Now, the yield on the company's debt is 8%, and the firm is in a 37% marginal tax rate. The debt is 32% of the total value of the firm, making equity, 68%. And so we put these things into our formula for weighted average cost of capital. 68% equity with a return on equity of 9.89, 32% debt with an after-tax return on debt of 8 times 1 minus 0.37 gives us a weighted average cost of capital of 8.34. When would we use the 8.34? Well, my guess is International Paper is pretty much a paper company. They pretty much, one project is pretty similar to another. And as long as the company is going to use the same level of debt, and as long as the projects are of equal risk to other projects in the company, 8.34% is fine. If, on the other hand, International Paper is going to make dog food, or going to make auto parts, or electrical equipment, or nuclear reactors, or who knows what, then I think we need to go back to the drawing board and find a beta that's appropriate for those types of projects. All right, that wraps up the chapter. Let's go through a quick quiz as we usually do. How do we determine the cost of equity capital? I hope you said we're going to use the capital asset pricing model. We just need to find the appropriate beta. That may be harder than it sounds. How do we estimate a firm or project's beta? Well, if we're looking at a firm and it's similar to the industry, we can use the industry average. Remember that the beta of a firm mathematically is the slope of a line that fits the returns on the security with the returns on the market. As far as beta goes, if if it's a project of a particular type, maybe we can find a pure play in the industry and use that industry's beta. How does leverage affect beta? Well, leverage increases the beta of equity. Remember, leverage doesn't affect the beta of assets, but leverage increases the beta of equity. And how do we determine the cost of capital with debt? Well, we use that weighted average cost of capital, throw things into the formula. And that completes the lesson.